Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 68, we're just going to get into some tax tidbits regarding 529 plans, especially surrounding the gift, estate, and generation skipping transfer taxes. A lot of the focus on 529 plans is around the income tax and how tax on the plan growth plus a 10% penalty can be avoided or deferred so long as distributions are made for qualified higher education expenses. So we'll look at a couple changes relevant to those, but without diving into the details of qualified higher education expenses. Really my focus for today's presentation are the items that often fly under the radar when it comes to estate planning for 529 plans. So when it comes to contributions to the 529 plan, generally those are going to be treated as gifts of present interest, and the significance of a gift of a present interest is that it qualifies for the gift tax annual exclusion of $15,000 per donee, whereas a gift of a future interest would not qualify for that annual exclusion. Now on its face, a 529 plan might look like a gift of a future interest because there is no immediate right of the beneficiary to withdraw plan contributions, but there is an exception under Code Section 529 which allows this. So generally you could contribute up to $15,000 per year to a 529 plan in the name of a beneficiary. However, there's a couple caveats to this. One is that neither the contribution nor any distribution will be treated as a qualified transfer of tuition. Now, there's an exception under the gift tax code sections that notes that qualified transfers, which are direct payments for tuition, will be excluded from gift tax regardless of amount. But that exception is not going to apply in the case of a 529 plan. Additionally, a donor to a 529 plan can superfund it with up to 5 times their annual exclusion without dipping in and using any of their applicable credit. So for example, the $15,000 per year per donee annual exclusion can be multiplied by 5, allowing a donor in this current year to contribute up to $75,000 to a 529 plan. However, that amount must be absorbed ratably over the next 5 years. And that prevents any other gifts to that beneficiary without using applicable credit for the next 5 years, so long as the annual exclusion doesn't go up. Now, there are some regs proposed that say that if the annual exclusion does go up, that additional $1,000 or $2,000 that might get added during the 5-year period could constitute an additional gift to that beneficiary, either a direct gift or an additional contribution to the 529 plan. Now, when it comes to the beneficiary, a lot of people don't recognize that a change of beneficiary could be treated as a taxable gift to the by the beneficiary itself. So we'll get into that in a second, but for the time being, it's important to note the low-hanging fruit that plan distributions are not gifts. Now, what flies under the radar is that if the beneficiary is changed, the old beneficiary could be treated as making a taxable gift, unless the new beneficiary is a member of the same generation or a higher generation, i.e. older, when compared to the old beneficiary. If there is a change in beneficiary to a lower generation, that will be a gift, and it could also be subject to GST tax if you skip a generation. Now, it's not just enough to have the new beneficiary be in the same or a higher generation. They also have to be a member of the family. Now, that's a pretty broad definition. It's too hard to summarize based on all the bullet points in the code, but I'll just mention spouse, descendants, first cousin, anybody in the grandparents' family tree within one generation, or the spouses of those individuals, and also stepchildren. Any of those could be treated as members of the family for purposes of this beneficiary change rule. Now, when it comes to estate tax, generally no part of the 529 plan will be included in the gross estate. Now, in the rare exception that there is any sort of amount to be distributed on account of the death of a beneficiary, then that part would be included in the gross estate of the beneficiary. And with respect to the donor, if they've superfunded their contributions using 5 times the annual exclusion, and they die before all those annual exclusions are used up during the 5 or fewer year period, then the excess contribution would be included in their gross estate. Now, you can fund a 529 plan maybe through a trust or through your will, but there's no expressly stated estate tax deduction applicable for funding a 529 plan through such means. Now, arguably, marital deduction could be applied if a 529 plan was purchased by a Q-tip trust, but that's too esoteric to really get into in this brief discussion. Now, as I mentioned, there's some changes in the Tax Cuts and Jobs Act that I want to mention. Some of these existed already and some, were new changes, but I want to highlight these just as items that are out of the ordinary for traditional thinking on 529 plans. One is that you can make rollovers to another plan for a beneficiary, to a member of the family of the beneficiary, or to an able account for any of those people, the beneficiary or a member of the family of the beneficiary. But you need to note that the rollovers are subject to the same gift tax rules that are applicable to a change in beneficiary. So if the rollover benefits somebody in a lower generation, generally that will cause a taxable gift by the old beneficiary, regardless of whether that new beneficiary is a family member. A new addition which doesn't help much but might help a little is that qualified education loan repayments can be made on behalf of a beneficiary and qualify as higher education expenses. However, the loan repayments are capped at $10,000 for life. Now, there is a carve-out with a separate account for separate accounting for a sibling, but for the time being, just note that $10,000 for life limitation, which doesn't give much bang for your buck when you're looking at $100,000 plus in student loans. But another good benefit is that qualified higher education expenses now just don't include higher education. They can also include attendance at elementary or secondary school, i.e. K through 12, as well as apprenticeship programs after secondary school as well. So any of those could fit into the definition of qualified higher education expenses. So the universe of potential tax-free distributions has opened up post 2017 Tax Cuts and Jobs Act. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you again for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.